The UK economy has been given a boost of confidence by a leading economic body in what has been a roller coaster week. But what does it all mean for investors? Well, joining me down the line to discuss all things from inflation reports to macro data is Robert Wood from Berenberg Bank in London. Rob, the OECD's more upbeat assessment of the UK refers to June and follows a flurry of positive figures from housing, manufacturing, construction and services. The findings do, however, mark a sharp turnaround from May. Do you believe the last 3 months present sufficient fundamentals to suggest sustainable growth?
Well, the outlook is improving and we are optimistic that the UK will record decent growth both this year and next year. We expect 1.4% calendar year growth in 2013 and 2.3% next year. As you say, I think what we are seeing is falling mortgage rates, falling household borrowing costs feeding through into higher consumption spending and improved business optimism. So we have seen the OECD's latest indicators turn up, and there's a whole host of other surveys and hard data that are positive. Manufacturing output grew nearly 2% on the month. In the latest figures, for instance, the purchasing managers' indices reached a record high in July as well. So the UK has grown for 2 quarters in a row, and it looks likely to continue growing for the rest of this year. That being said, the UK is not out of the woods yet. This is just the start of a recovery. Output in the UK is still more than 3% lower than it was in 2007. Unemployment is close to 8%. We are a long way from normal and have a long way to travel to get back there. Moreover, this recovery is being bought by households lowering their saving, and that cannot go on forever. So over the next year, we need to see real wages improving, exports growing, and investment also increasing if this is going to become sustainable. We're optimistic about that, but nevertheless, it is a forecast.
One of the highlights, as it were, of the week was the much anticipated inflationary report. Afterwards, however, some investors were left wanting. What is your take on this forward guidance, and how effective is it really in terms of giving clarity to the markets?
Well, the bottom line on guidance is this is one of the factors that is making us optimistic about the chances of continued recovery and the recovery broadening out to other areas over the next year. I think the guidance is important and a powerful message. Saying interest rates will remain low probably for 2 or 3 years. I mean, we can debate exactly how long it's going to remain low and when the unemployment threshold will be hit, but it's certainly some time off. I think that's a powerful message. Until now, about a third of the public were expecting interest rates to rise in the next 12 months. So this is an important message. Keeping rates low will help consumers continue spending for now, and will also incentivize businesses to go out and invest a bit more. So I think it's important. It disappointed markets, though, at least initially, because the unemployment threshold was relatively cautious. I wouldn't make a big deal of that. It's just, I think, markets have probably got a little bit ahead of themselves in how dovish the Bank of England would be. Looking through that initial reaction, this is a very important announcement, and one that's good for growth and good for the chances of continued recovery.
As part of forward guidance, the Bank of England won't start to sell off the £375 billion it is holding in gilt before the 7% unemployment threshold is hit. According to some analysts, this means the UK Treasury can look forward to more years of cheap borrowing, but also a potential cliff when the BOE finally decides to start selling off those bonds and interest rates rise. What do you think of this danger looming? How far off is it?
Well, it's certainly a danger. We've seen when the Fed started talking about tapering that yields can move pretty sharply. So there is definitely a danger of increased volatility and movements in yields. And I think it will certainly increase attention on unemployment figures, for instance, as they come out. That being said, Treasury yields in the US even now are 2.6%, which is not a damaging level for the Treasury. And I think the Bank of England, having seen the US experience, will do absolutely everything it can to be as clear as possible about when it will sell gilt and at what speed to stop any volatile market movements. I think it's still a long way off the Bank of England selling down gilt years, probably after Mark Carney has left. So I don't think it's an immediate risk, and I think the Bank of England will do everything it can to stop any particularly damaging rise in yields.
As we've alluded to, Carney's testament was seen by some as the Fed 2.0. But how do you see the two currencies performing against each other moving forward? And what impact will it have on UK bond yields, do you think?
Well, I think the key thing for me here is that the UK is in a very different position from the US. US output, as I said right at the start, is already above where it was in 2007. For the UK, we are still more than 3% below that position. So I think the UK has further to travel and longer to go on this journey than the US does. So I see UK policy being more dovish than the US going forwards, which I think weighs on sterling a little bit. I mean, what we're seeing more recently, of course, is the slight disappointment about guidance feeding through to slightly higher sterling. But I think, over the next year or two, we're looking at a more dovish Bank of England than Fed.
Robert, thank you so much for your time today. Well, viewers, for an overview of the main market movers and shakers this week, click back to Dukascopy TV for our wrap-up with Thomas Taplin. But for now, goodbye.